name is Ken Scornia, President and CEO of Krilogy. This is my partner, John MacArthur, Chief Investment Officer here at Krilogy, and this is your January market perspective. Welcome. Johnny, good to be with you. Happy New Year. I guess it's still Happy New Year, January 17th.
We're off and running.
In December, we broke our discussion into three different segments, broad topics: the Fed and their policy, the economy, and earnings. Even before we sort of get to that, though, the market's kind of had a little bit of a run here in the first few weeks of the year, and today's a little bit off, but overall it's been up.
Yeah, welcome sign. Yeah, here we are, midway through January at this point, and the bond market's up 3.5% just about. We've got the S&P 500 up about 4.5% out of the gates, which is certainly a welcome sign. We've had inflation roll over now for 6 months in a row, continuously. That's helping. So we're definitely seeing the ease in inflationary pressures.
Peak in about June, you think?
June peak has held and will hold. Yeah. So that's certainly a catalyst. We've seen
the tech people, tech stocks who have
tech stocks have
bounced back dramatically.
We saw an abnormally high amount of tax loss selling in December of last year. If you think about it, outside of 2018, in which the market was down very modestly, we just haven't had those opportunities. So I think investors were seizing the moment and doing a lot of tax loss harvesting. So you're seeing a nice and healthy and normal bounce back this month. Without question. I think one of the things that sticks out that's noteworthy as we start the year and really look back to June of last year. June was not the low in the market, but one of the two big lows. Of course, the other one being October 13th, which has marked really the line in the sand for the S&P at this point at around 3490 in the S&P 500. But ever since mid-June, on an even weight basis, we've seen sector performance really strong. So from that period, the S&P's up about 8%. But you look at even weight sector exposure, you've got consumer discretionary up about 22%. You've got energy, financials, healthcare, a lot of segments, a lot of value-oriented segments in particular that are up mid to upper teens, if not more, since then. And it's just a good indication of breadth in the market. You're seeing your average company do better and perform better, and that's really important. By the way, in reference to that, if in talking about consumer discretionary, Amazon and Tesla and the market cap weighted discretionary ETF are the lion's share of the assets in that fund, and Amazon's still down 6 or 7% from that date, and Tesla's down about 45%. So the breadth of stock performance of your average stock is a good sign.
And held up. And so we'll get to more on the market here in a bit, but let's go to Fed and policy. They're still hawkish. They're trying to put a lot of headwinds out there into the economy. Tell us what
they're still hawkish. The rhetoric is still hawkish. They've done the lion's share of the heavy lifting from a policy perspective. The bond market is recognizing that and calling bluff in some respects in that, inflation is rolling hard. I mean, if you look at M2 money supply on a 3-month basis, it's at a negative 5% annualized decline. That's never happened.
Right.
So liquidity is definitely drying up. And so tightening conditions are happening for the Fed. It's so they've done most of the work, but it's really a question at this point how long they stay elevated. And frankly, I think investors should expect that.
They've written their prescription. The patient is taking the pill. And now they have to consistently take the pill until the Fed believes it's over.
And there are no really minimal spillover effects at this point. Right. I mean, if the market's held in there decently. Started the year off strong.
Labor's still strong.
The labor market. I mean, we're getting over 200,000 a month in new job creation. Now we could debate on how it's measured and part-time work versus full employment, et cetera. But I mean, the backdrop is really giving the Fed in the loose financial conditions is giving the Fed permission really to stay longer from tight policy perspective.
And the old inverted yield curve theory,
Yep,
still there?
still significant. Gosh, in fact, the 3-month T-bill relative to the 10-year Treasury, which is the most accurate of all the kind of the yield curve barometers, the most accurate, it's at 4.62 on the 3-month T-bill, and the 10 years at 3.5.
Right.
So I think the bottom line here is this is going to still likely take time. We're seeing some positive signs that's welcome, but really the magnitude of the rate hikes that we saw last year are just starting to show up in recent months into the economy.
Yeah. So, and speaking of the economy, so the labor secretary this morning was on CNBC, and he was speaking to his stance on labor. His job is to make sure that we have strong labor and high wages. The Fed is actually wanting the opposite. These cross currents that are happening, both with the Fed and or even the political sphere, has a major impact on the economy.
It really does. It's a great point. We're at essentially full employment.
Yeah.
An unemployment rate at 3.5%. The Fed can't overtly state it, but they really need the best way to solve for the supply-demand imbalances is truly unemployment rising.
Right.
So, if we're 3.5, slightly above now, I don't know where it has to get, but, again, with easy financial conditions, weaker U.S. dollar, lower rates, strong stock market.
I think that's actually going to be their hardest part. That's going to be their hardest challenge. Because you and I were in a meeting about 4 years ago, maybe 3 years ago. One of our clients and close friends who ran a consulting firm said, we went around the room and said, hey, what are some challenges going on with your business? And this has been a theme since then. He said, we need more humans.
Right.
And there are just not enough people to fill the positions in the economy today. And that's going to be a hard one to figure out.
That's right. And that trend over time is going towards more automation and higher productivity focus, less cost. And so there's a push-pull there in play for sure.
Absolutely. So we got the Fed, their policy. We have the economy. At some point, it's going to reflect in the earnings.
Yeah.
Earnings so far have been okay.
So far, yeah.
We just had a miss on Goldman today, but for the most part,
Morgan Stanley was up, kind of washing each other out, so to speak. We saw the big banks go Friday.
Yep.
A lot of volatility around that, but they ended significantly stronger, which tells us, again, early signs here that there's been a significant amount of discounting that's already taken place. Now, we could suggest that the impact of rates continuing to show up in the system and the Fed staying tight for longer with a couple more rate hikes likely, that we could really be looking at that evidence of the impact of monetary policy showing up in future earnings quarters. But as we sit here now, we're at estimate of 230 for the year.
Right. If we hit a recession,
Mm-hmm.
right, or some would say if and when,
Yeah.
right, that average earning decline is 26%.
On earnings, which is significant. So just for perspective, S&P earnings for 2022 calendar year will probably be around 220.
Yep.
There's still 5% earnings growth really built in at current numbers that call it 230.
Yeah.
Your point about the average recession earnings declining 26%, that would be 165.
Right. Big number.
That is
seems hard to fathom.
It seems hard to fathom.
Yeah.
We've often talked about the strength of corporations financially speaking and the consumer coming into this period, and that will help weather the storm, we think, in large part. In terms of how much, I think remains to be seen. Remains to be seen. Because we're seeing, without question, spending holding in strong, but we're also seeing credit card utilization exploding.
Right.
So there's some anecdotal things that would suggest that the consumer is continually getting stressed, and whether there are spillover effects in the months and quarters to come.
Personal balance sheets are as strong as they've ever been, but there's also some serious things to consider. Home equity line of credit for most people just reset at a massive number, sometimes double or even triple the rate.
No question.
Which is an immediate impact on someone's budget. Credit card use is going up; those rates are going up all time. So you have some risk on the consumer there that at some point is going to spill over to earnings.
Yeah.
which at some point will spill over to, the valuations of the organization.
That's right.
Companies.
That's right.
So,
Let me take some time.
any other things, closing remarks, any other items you see out there that we need to be considering?
Yeah,
in terms of portfolio management?
I just think in terms of, think beyond, in terms of equity positioning, think beyond the market cap weighted S&P, which is typically characterized by, last cycle's winners for the most part.
Right.
Large cap tech, again, we're seeing some healthy bounce back there, which is great and welcome. I think cash flow, just in general with investment strategy is really important. Once again, it's kind of been irrelevant for well over a decade now with the theme of growth.
Yeah. Companies that create excess cash flow.
Absolutely, I think that's really important. Even looking at the bond market side of things, you can actually get yield out of fixed income, which we haven't in a long time. And then I think just discipline around execution of the investment strategy is important. We've seen a lot. We've been in some meetings together here lately. The attraction, human nature, is to grab the short end of the yield curve because that's where it's most attractive from a yield perspective, and you don't have to commit to a long period of time. However, there's meaningful reinvestment risk there. So recessionary conditions play out. Those short-term yields over the next couple of years are going down and potentially significantly down. So having exposure throughout the yield curve is important.
I feel like when I ask you that question, we're like professional football coaches, right? Where it's like, we'll stick to the fundamentals.
Right.
We'll continue to do what we do over time. We know over time it's going to win. But there are some things that on the short term and on the immediate sort of portfolio management side that are really critical to your portfolio. Cash and what to do with your cash at the moment is a conversation that really has only happened in the last 6 to 8 months.
Without question.
4 years, and you could argue even a decade, you hardly even spoke of cash because there was nothing to do in that space.
Non-starter.
The bond market is no different. You have to navigate yourself through the bond market today, where for a long time the rates were so low, you kind of just set it and forget it.
Right.
And then, of course, the stock market is so volatile, and there's pieces and opportunities in there to find that the old set it and forget it program gets really, really difficult when you're managing your portfolio today.
It does.
And then layer on all of that on top of your personal wealth plan and how all this impacts. And then we say, stick to the fundamentals. It's a long-term market. Be patient. So lots to think about for the investor today. But I would say this. With your team and what you're all doing with our portfolios, if you're really confident in how we're putting things together. And we just want to thank you all for your trust in Krilogy and our wealth advisors for being stewards of your wealth in your portfolios. I would say for John MacArthur, my name is Kent Scornia. Thank you very much. Have an amazing day.
Thank you.